Hello traders, hope you guys doing well. My name is Alejandro Zambrano and I'm the Global Chief Market Strategist with ATFX in London. Let's take a look at the markets and let's talk a little bit about next week's Fed rate meeting. So on Wednesday the 19th, the Fed will announce what they're going to do with their monetary policy. They're also going to update their economic projections. Now, the way the rates markets are positioned right now, they're giving it about a 25% likelihood of the Fed cutting rates with 25 basis points and another 75% likelihood that interest rates remain unchanged. Now, it's still an interesting meeting because economists do anticipate that maybe in July they're going to cut rates. So what people think is that the Fed next week is going to tell us what they're going to do in July. And in July, there's pretty much an 86% probability of them cutting rates. At least that is what the market has priced in. And there's several reasons for the Fed now turning gloomy, and we're going to explore some of these. And we're going to begin with the first set of data, which is the market PMI indicator. This is the composite you're looking at. And you can see that the indicator has been dropping quite sharply over the last few months. And we're relatively close to that 50 boom and bust threshold level. Now, this is a composite, so it's a combination of the services and manufacturing PMI for the US that is supposed to sort of tell us what's happening in the US economy. Now, again, if we trade below the 50 level, it's quite likely that the US economy would stall. And because of the new tariffs introduced on Chinese imports, it's more than likely that this is going to slip below the 50 level. But there's more things than just this. This is the core consumer price index. Now, this is the PCE. So it's the preferred measure of inflation of the Federal Reserve. And you can see here how inflation was pretty much at the 2% target from pretty much August until March 2019. But since then, the inflation figure has dropped sharply. And as you probably noticed as well, with crude oil prices being low again, it's unlikely really that we're going to see inflation ticking up. And then, of course, with the market PMI figures looking really, really weak, there's no real reason to anticipate a bounce in inflation figures right now. Now, the sort of the final nail in the coffin, I would say, that sort of caused the Fed to probably turn more dovish is the NFPs. So that's what you're looking at right now. And 2019 have not started really well for the US economy. The first reading here was pretty much around 56,000 new jobs created. And then you have another reading here of 75,000 new jobs created. Of course, if it was only about the NFP, I would have taken things with a little bit of a pinch of salt. But the ADP economic employment indicator also printed really, really low in the latest reading. And that indicator has less of a standard deviation than the NFP figures. And because of that, I think it's not a coincidence. And the NFP is truly sort of telling us what's going on in the labor market. Of course, things could change dramatically over the next few months. You know, the economy and the NFPs are very volatile. But if they don't, which I don't think they will do, then I think there are some possibilities to, for example, see the dollar yen potentially trade lower. So if we look at something like the dollar yen, we already had that sharp decline here. And the market is definitely in a bit of a downtrend. And I think as long as you trade below 109.92, people will try to sell. Now, to get a decent risk-reward ratio entry, I think people will probably hold off with being bearish from pretty much 108.96 or 108, 109 really, and try to be selling here. And one of the reasons for that is that US stock markets have gained quite sharply lately, and we haven't really seen the same sort of price action in the dollar yen. So it could be that the dollar yen still needs to catch up a little bit, and then eventually I think we're going to head lower. Another market to keep an eye on is the Fed. Now, the ECB and the euro dollar. Now, the euro dollar has been trading within this wedge for about a year now, and I don't really have very high hopes for this actually breaking out. But for now, at least the trend is bullish, and I will treat the bullish above 112.18. So as long as we're above that level, I think some people might try to buy where we are right now with the price, and then eventually see the price going upwards. And if we forget about the technicals for a few seconds, just think about the fact that the ECB tends to react rather slowly. Their economy is not doing too good at all. And what we've seen in the past, they tend to react slowly, even badly. I remember, I think it was in 2008, when the Fed was cutting or being very dovish, when the market was sort of tumbling over here on the back of the financial crisis. The ECB were very hawkish until very last minute and then reacted very late. So it could be something similar here again, that they could react very late. And what would happen during the interim period would be that the Fed would be cutting rates where the ECB would be neutral, and that would potentially lead to the euro moving upwards on that policy divergence. But of course, on something as simple as the fact that a lot of people have been borrowing money in euros. So they borrow money because interest rates are negative in the euro area, and then they take this money and invest this elsewhere. And that is where and this money would eventually need to flow back, because when the world is in crisis, people don't care about small things like interest rate differentials, because the move in the asset is bigger than any yield advantage you're gonna get. So what tends to happen is that a lot of people go back and they hedge their flows, and that tends to sort of cause the funding currencies to gain. And the two funding currencies right now are the euro and the dollar yen, and also to some extent the Swiss franc. So that's why we tend to see those currencies gain. Okay, this concludes today's update. Don't forget to subscribe to our YouTube channel, and don't forget to leave a comment and maybe even a like. Thanks so much for watching.